Okay, ladies and gentlemen, today we have a very exciting guest to our podcast. Today we have Dr. Nicola Powell from Domain. She is the Chief of Research and Economics for Domain Australia. She's got 15 years experience in research that spans across the academic, government and private sector. 10 years of that has been specifically in property and 7 of those at Domain. So Nicola, welcome aboard.
Thank you. It's an absolute pleasure to be here today. And look, I will admit my favourite pastime is talking about property. I do it not only in work, but also outside of work. It's what my friends want to talk about. It's if somebody sees me in the street, they want to chat about it. I think, as soon as someone knows I'm a property analyst, that's it. That's all they want to talk about.
Yeah, definitely. I can relate to that passion. I think also it's a bit of an Australian passion across the market, right? The Aussie dream to buy a home and own the roof over your head, right?
It absolutely is. And, I think this is a really interesting aspect of our housing market because they call it behavioral economics. And it's that behavioral side of our property market that I find really fascinating. The drivers of, that emotional attachment to a home that you don't want to leave, or the attachment you get to a house before you've even owned it. I'm actually from the UK originally, and the obsession with real estate just isn't there in the
It's not
UK.
the same. Yeah.
Absolutely not. Like, you would never ever see, somebody, a property expert on a morning show talking about,
Mm.
a luxury listing or talking about market dynamics. Whereas in Australia, it occurs a couple of times a week. My colleague is on the Today Show twice a week talking about real
Mm.
estate. So that obsession is totally there. I'd love to kind of understand, where did that obsession actually come from for Australia?
Yeah, it's so true. I feel like it's systemic, right? It's been for generations a bit of an obsession. And to your point, I completely agree and sort of have witnessed and been privy to the same things in America as well.
Mhm.
Americans aren't as passionate about the property market over there. Most people are content in renting, and if they accrue any wealth, they go buy shares, right?
Yeah, I think there is this little bit of connection, though. I think it's very much seen as success.
Mm.
Once you've purchased your a home, it is really that flag of success. And we have a lot of, not only you're an owner occupier, but a lot of mum and dad investors. It is a way to diversify, I suppose, wealth and income, and providing that security, I think, long term. And probably that is the main word, is once you own your own home, you feel that sense of security.
Yeah, security's feel like the other big one is that people don't really feel secure until they've sort of put a deposit down on their home and they're paying off a mortgage rather than paying rent, right?
Yeah, totally. And my first thing when I meet someone that's just purchased their first home, I say to them, congratulations, because it is such a hard journey to, purchase your first home,
Mm.
particularly if you're in the East Coast, where we know property prices are extremely high. You've got a median house price in Sydney of just over 1.5 million. And so to actually break into the housing market, particularly if you don't have the support of mum and dad, bank of mum and
The
dad,
bank of mum and dad. Yep.
yeah, it's such a milestone within your life that, you really need to take that moment in time and just really celebrate the success of your first step on the property ladder.
And that first step's the hardest, right? That's what we always sort of preach to our clients. Once you're in the door, once you've got your foot in the door, I should say, then you can, have the compounding effect of equity growth and that sort of snowballs into making the second or third or the upsize and whatnot. Sort of the second or third purchase and the upsize a lot more sort of feasible as such, right?
Absolutely. And I do think that we need to kind of break down barriers of what our perception of a first home is, because there is this phrase in Australia that I've always been fascinated about, and the quarter acre dream, that quarter acre block, where actually realistically, if you live in a major capital city, that is not your first home. What you
Hmm.
need to see is your first home is the first step on the ladder, and it's
Mm.
about a transition. It's about, as you said, building that equity, and it's
Mm.
that pathway to getting your dream home, which may be that quarter acre block in some of those family suburbs. But I also think it goes back to education as well. I've got 2 young kids, and I teach them at home. They're young, so about to turn 8, and they're 4, and the youngest one's 4. But my currently 7-year-old, almost 8. I teach him about, he needs to save. Think about where you're going to live. This
Mm.
perception that he can't live at home forever. And I tell you a quick story. This is a bit of a personal story. He
Yeah.
gets pocket money, and he was saving for something that he really wanted. He was buying actually a bike. And he handed over the money, took the bike away. And then when he got home, he cried because he didn't have his money anymore. And this realization that, you're spending money, and he wants to spend mum's money, but not his own.
Yeah, exactly. Yeah, it's a good realization to have at 7 years old.
Oh, totally. I mean, as
Yeah.
property analyst for a mother, I actually think this is an education piece too, and I do think that our school should play part of this. Is about
Mm.
financial education. As parents, it's our duty too. But I think anything that we can help our children to really focus on that bigger picture and their journey in life. I know it's very hard when they're younger, but it starts with those small things and builds into those bigger pieces. And that's what I have taken on with my kids, is the importance of financial independence and the importance of how you're going to save for your first home. And those conversations have started with my
Mm.
kids being very young.
Before we start going into all this data questions, because I've got a lot to ask you, but you sort of we're going off gender here now, but where you sort of mentioned the UK, and then I've mentioned America, and sort of what you're now talking about. I feel like, does that education of mum and dad to the next generation, is that what's maybe instilling Australians to become more property focused than other sort of leading nations of the world, you could say, where there isn't such a belief in property? What I don't understand also about some of these other markets is that the property doesn't actually grow in value as
Mm.
aggressively. And is that because of purely the beliefs of the individuals in those marketplaces, right?
Mm. Yeah, look, and I think with Australia in particular, it probably boils down to, years, decades ago, when Australia, we're a migrant country. And I think that when you kind of got that first wave of migrants into Australia, I think the realization that they can actually purchase their, block of land and purchase a home, I think that's where it originally stems from. And I think,
Mm.
as you say, it's how you then teach the next generation. And I think that proudness of owning your own home and that financial independence and that security has probably been passed on from generation to generation, and has
Mm.
really created the Australia and that Australian dream of that quarter acre block in terms of what we see today. So,
Mm.
yeah, and it's interesting you say that because, one of the other aspects is when I'm talking to people looking to purchase a home is you have to remember that it's actually the dwelling on it that tends to go backwards in price, but it's actually the land that
Mm.
appreciates in price. And so I always say to people, consider what parcel of land you're actually buying, irrespective of the house. If it's in an older suburb, push yourself, try and get the biggest block that you can, or get that block. You always get these blocks in certain suburbs where it's a corner block, so actually the square meter of land is actually slightly bigger. So be strategic and look at things like that in terms of, particularly some of these I'm going off track here. Sorry, I'm
No,
kind
I
of going.
like this. This is fantastic. This is exactly what we want.
I always go to people, have a look at some of those inner or middle ring suburbs where, you might eventually get a zoning change. And I actually live in the ACT, and you can see that happening in parts of the ACT, particularly where we went through the Mr. Fluffy blocks and you had these massive parcels of land, 1,000 square meters. And then they get sold and you can subdivide and then put two houses on. And that's
Mm.
actually a way of creating wealth for yourself.
Mm.
So, I think that's what people look for and seek for in the property market. Not only is it obviously you want your family home, but there's this also other aspect of, people land bank. And you see that in
Mm.
some of those really expensive suburbs like Mossman, where you have a dwelling and it's just, you can tell that it's land banking because no one lives there. The garden's overgrown. Somebody's purchased that with the forward thinking view of they could maybe eventually put maybe 3 or 4 townhouses or 6 low-rise apartments onto that block and actually create a bit of
Mm.
wealth for themselves.
Yeah, the intrinsic value in the land itself, and the
Mm.
future sort of opportunity of that. I'm Greek background myself, and my father's one of those migrants, you could say, from the baby boomer sort of generation that always preached about buying land for exactly that reason. They weren't
Totally.
big on strata units because it's developed, it's fully utilized, but
Totally. Look,
buying
some of the
land
best
is the best.
some of the best advice I've got is from Greek friends, actually, that
Yeah.
have that same, I think that older generation, and I think how they view property as an asset. And actually, this is really hard for people who are purchasing a home that they want to live in. And all of my friends, I always tell them, take away the emotion. View
Mm,
this as a transaction, as an asset. Don't think about placing the rug in a certain room before you've purchased the home.
mm,
Think about this as, it's a massive financial commitment. It's most people's biggest financial commitment. You've got to see this as a business transaction
mm.
first and foremost, and then let the emotion come
Well,
in once you've secured your property.
especially because these individuals, these decisions they're making are the biggest financial decisions they'll make in their lifetime, and they're probably
Yeah,
only going to make a handful of these decisions, right? So
yeah,
they should really do their research and sort of dot their i's and cross their t's as such, right? You touched on
absolutely.
something I want to go back on, zoning changes. So
Oh, yeah.
sorry, just that was a really good point, and I feel like a lot of people hear of this concept, understand this concept. So, how does the average punter, how does the average Joe Blow understand,
Yeah.
get exposure to zoning changes, or foresee where these might come in?
Oh, it's really hard. I actually think it's probably hard for the industry. I
Mm,
think for developers out there, when you're putting in a development application, and I'm talking even if it's for a small level, a low level apartment or, a handful of townhouses, the amount of red tape that a developer has to jump through is significant.
mm,
Generally speaking, you have a zoning in your city. And I mean, if you just Google, zoning in Sydney, and it will drive you to the right site to have a look
the
at.
planning portal.
Yeah, totally. Generally speaking, major zoning reforms only happen once every 10 years.
Mm,
What you can do is apply for a spot change, in terms of you might have a large block and you want to subdivide and you can ask for a spot change. They're very hard to come by. Local councils are generally are the ones that are, and this is where that NIMBY effect comes in, that not in my backyard. So, you may have a block of land you want to put townhouses on and it's zoned for that, but you may actually get rejected by council because of locals around the surrounding area that are going against that development application. So
mm,
it is challenging, and I think local councils should have more accountability. I think for meeting supply, and I know supply was one of those things we wanted to jump into to talk about today. But I feel like this is a lovely natural segue.
yeah.
Local councils actually need, I think, greater levels of accountability to meet their supply levels, because I think we have an undersupply in Australia. We have very high property prices,
Especially Sydney, right?
especially Sydney. And I think,
Mm,
to address affordability, it not only comes in terms of urban sprawl, it's also about urban infill. And what I
mm,
really want to clarify here is I'm not saying let's stick a load of high rise in our middle and inner ring suburbs. Absolutely not what I'm saying. But what I think we need to really look at is make sure those high rise are on those growth corridors around, major arterial roads close
mm,
to, rail links and transport hubs. But I think it is about that missing middle of affordability, which is terraced and townhomes in some of those inner and middle areas. So I'm talking much more low-rise developments. And I think, the NIMBY effect, and I think we all know a NIMBY. I know a NIMBY that is in my family and, goes against developments. But on the same breath, we're also screaming, oh, my child can't purchase a house, they can't break into the market. So we really need to have big picture thinking here, and we need
mm.
future thinking around how we actually provide affordable housing in the right areas that people want to live and the right types of homes that people want to live in.
Mm. So I think sort of what you're touching on there is that the state government puts certain sort of development controls in play, and I think there was a recent update last year with this sort of subdivision of one dwelling into two, where
Mhm.
if it's 400 square meters, if it's I think 12 meter frontage and these certain parameters, you're able to go under a um, complying development code CDC and just subdivide the property into two, right? But then local councils intervene and put
Mhm.
their overarching policies on top, which
Yeah.
sometimes prevents these things, right? So I
And as
think
a neighbour, you're within your rights to go, well, I actually don't want two dwellings next to me. And then that's where you get that NIMBY effect of, it's it's the changing face of our suburbs as well. We have a swelling population, and you can't expect that the landscape of our suburbs is going to stay the same. Obviously, you've got to keep and retain some of those, green spaces and parks and heritage natures of our suburbs. But I do think you definitely need urban sprawl. But the other
mm,
issue Sydney has is urban sprawl can only go so far because you've got
exactly.
mountains one side and you've got ocean the other side. So,
Mm,
and a stat or, a database fact here, Australia is home to some of the least dense cities in the world, and we
mm,
have global cities in Australia. So I think that puts it into context that we live on large blocks and we live in large homes. And
mm.
I think for affordability to come into this conversation, there's an aspect of that does need to change.
Density needs to change. We need to allow more density in more areas, basically. But I think also just sort of back on that zoning comment and conversation, I think for those investors doing or looking at doing what you were referring to, the best thing for people like that is to engage a town planner, right? Get someone who's got market insight and understanding of council's sort of rules and regulations as such, and let them guide you through that journey. I'd say, right?
Absolutely. I think experts in this field are, worth their weight in gold. I think
100%.
when you're thinking about spending a significant amount of money, and you're wanting to build that wealth for yourself, experts in their various different forms are really important in this journey.
Mm.
And finding that trusted expert as well that you feel that you're getting great advice from.
Mm. Well, let's dive into the stuff that we actually were planning on talking about, right? I think we're 20 minutes in now, and we've actually just spoken about holistic stuff, which is fantastic, exactly what these podcasts are about. So thank you for that. But so let's talk about a few topics. We've got obviously the hot topic that never ends. It's been going on for years, this topic, interest rates, inflation, and this mortgage cliff that's we're now deep in the middle of. I think we're at the peak of as such. But let's firstly cover interest rates and inflation. So we've seen 12 rate rises now. The last one being in June. We have a cash rate of 4.1%. There is conversations that we're at the peak. Inflation looks like it's steadily easing. I think the most recent monthly indicator was around 5.4. Globally, they've tackled inflation a lot more aggressively. Well, in the in the US, they definitely have that more of a foothold on it. I think in the UK, maybe not so much. I think in July they increased rates again, right? What are you on the topic of interest rates and inflation? What are you seeing? What's your sort
Yeah.
of crystal ball there?
Yeah, so you're right. We saw 12 rate hikes, but I actually like to see it as 16 because if you class every 25 basis points as a rate hike, there were 16 because we've had a
Yeah,
couple of 50 basis points in there. So it was 12 decisions from the RBA, but really was like 16 rate hikes. So
great
what that
point.
does, is really just highlights the change in financial conditions that we've seen over the last year and a bit. It's been significant, and I think everybody is hurting in terms of higher costs of living and obviously reduced borrowing capacity. Borrowing capacities have reduced by 30% because of the high cost of living, because of the change in the interest rate environment. But the positivities here, absolutely right. We're coming off of the peak of inflation, which occurred at the end of last year, and on a quarterly basis, quarterly inflation is now at the lowest level since September of 2021. And I think what we also have is, so if you look at the cash rate, there's what's called the market implied yield curve. So for those that don't understand what that means, it's basically the market giving a probability of where is the next interest rate move going to be. And it looks about 12 months forward. So if you look at the cash rate and you plot this market implied yield curve, what that's telling us is that we are very, very close, or if not at a peak of the cash rate. And actually, it's pricing in that the next movement from the RBA is likely going to be downwards. But what I will caveat that with, that's unlikely to happen until, say, mid next year. The market is pricing in an interest rate cut around August of next year. I'm of the view that we're probably likely to see an interest rate cut slightly earlier. But I think this is really good news. I mean, it's not going to happen until next year, an interest rate cut. But I think, we've had the RBA now have 2 board meetings where they've kept the cash rate steady. So I think these are all good. These
Signs.
are all kind of good. Yeah, that's the word. Good signs. Thank you for rescuing me there. They're all good signs in terms of and I even think moving into spring, they're good signs for people to have confidence. And I think, what we saw was such a change in borrowing capacity. And when you think, if you're looking to purchase a home, that can be very unnerving. And we actually saw that coming out in market dynamics in terms of people delaying their decisions to sell their home because there's so much uncertainty out there.
And so speaking of good signs, I think the other good sign, which is a bit of a negative, but for economists, it's perceived as a good sign. Last week we saw unemployment tick up a little bit, right? Which is also what they're trying to achieve.
Yeah, it is. But I mean, unemployment still remains really low, and it's pushing up wages. We have got a low unemployment rate, and even in New South Wales, it's a historic low level of unemployment rate. But we've still got really this tight labour market, and they do want unemployment to push higher. But even the RBA are forecasting that even by the end of this year, unemployment rate is still going to be below the decade average. So it's still going to be quite competitive. And I think what you've got at the moment is this kind of mismatch between inflation and wage growth. So while we have got wage growth, it's the strongest in a decade. It's only at 3.6%. And what's inflation running at, roughly 6%. So technically what that means is households are actually going backwards financially. Their spending power, their borrowing power is going backwards because inflation is running so high. What we're likely to see next year is it will tilt back in favour of households because we're seeing that inflation come down, and actually inflation is easing quicker than what was expected. And we're still expecting wages growth to kind of tick up and be higher than what it historically has been. So that kind of seesaw effect will be back in favour of consumers. And, I think that's probably the space that we want to be in, which will be sometime next year.
So you would have obviously an abundance of data there in your, role at Domain being Chief of Research and Economics. Tell me what are you guys seeing from the data on that comment of households? With this, mortgage cliff that we're deep in the middle of at the moment. We were forecasting, or people were forecasting, that there was meant to be a huge influx of potential listings off the back of this mortgage cliff as people went from 2% to 6% interest rates and overnight couldn't afford their home, would have probably been foreseeing the problem and maybe preparing to sell either their investment properties or their homes. Is the data indicating that? What are you seeing?
Look, it's been really interesting to watch. So what we've seen is sellers were pulling back. So since spring of last year, so September of last year, we really saw sellers delay decisions, and they, that's understandable, and is actually something that we tend to see when a market goes into a downturn. Because if you think you've got 1/3 of homeowners own their home outright, you've got another chunk, about a third, that are purchasing with a mortgage. You're only going to sell if you have to, if you're going to sell for the right price. And that's understandable. That's part of the behavioural economics of our property market, like we were discussing earlier. So we saw this massive pullback in seller activity, and that was pretty consistent. But what we've started to see is it has changed. So what we've seen over the last 3 months, and this is particularly a Sydney trend, over the last 3 months, we've seen new listings rise. And it's the first time in just over a year that new listings are now higher compared to this time last year. So in Sydney, they're 10% higher compared to this time last year. So I think it's two things. I think when you're deciding to buy or sell a home, you tend to not change that decision. You delay it to time it right. And that might be market timing, that might be personal circumstances. And that's exactly what we saw. The pullback in sellers when the market was going into a downturn. And what we've seen in Sydney is a persistent pricing recovery. I mean, Sydney is 2/3 of a way into recouping what was lost during the downturn. So Sydney house prices have recouped about $100,000 of the $150,000 that was lost during the downturn. So you've got sellers motivated by that. You've got some areas now with record pricing, so they're going, this is a good time to sell. And we've seen that come in as fresh listings. The other, my very long-winded answer to you, is the other side to this is, well, what's driving that? I'm always like, well, why is this happening? What are we going to see next? Why is the market reacting like that? So yes, listings are rising probably because of that pent-up supply. But the other side, which goes back to your question, I was going to loop round and get back to that, was what we could be seeing is people wanting to sell their home before they get into financial stress. As you said, you've got people going from a 2% to a 6% or above environment. The weight of holding a mortgage and the cost of holding debt has changed significantly. And for some, that is going to be too much for them to actually financially cope with. So I do think that we've probably got a bit of both. We've got that pent-up supply coming to market, and I think we've got some people coming to market probably because they want to sell their property before they get into financial
position. And they've had plenty of warning. Whilst it might have been a overnight increase when their fixed rate expired, the media has been talking about this fixed rate cliff for a long time. Interest rates are on the news on a daily basis, and people were fully expecting what was going to happen once their fixed rates expired, right?
Absolutely.
Another comment that I want to go back on that you touched on, you said listings are up 10% from this period year on year, and we're going into the spring selling sort of market, which is historically one of the busiest markets. But 10% on listing volumes last year. Wasn't last year a bit of like a record low still in volume of listings? I think for Sydney, we're talking about in particular, it's still trending like much lower than the 5-year average, right?
It is. So overall, what total listings are. This is the nuances between it all. Total listings are still below the 5-year average. Total listings are still down compared to this time last year, but it's the new listings side that are now ticking up, those fresh listings. And we know that if a home lingers on the market too long, the longer a home is on the market, the deeper the reductions are in terms of pricing. So one of the things I always look at in terms of really helping to kind of pulse check where are we in the property cycle is this dynamic between new listings and current listings. Total stock is down compared to the 5-year. So in Sydney, I'm just looking at my notes here in terms of the figures. Total listings are down 11% compared to the 5-year average in Sydney, but new listings have started to improve, and they're actually slightly above the 5-year average in Sydney. So we're starting to see that trend change.
Wow. Okay.
Yeah, and the new listings part is really telling of how do people feel about market dynamics? Are they motivated to sell their home? Do they think that it's still good conditions to sell? Absolutely. I mean, in Sydney, you've got clearance rates still knocking around that 70% mark. We've seen prices recover, some areas at a record high. Generally speaking, overall, 2/3 into recovery for Sydney house prices. I think spring is going to be interesting because I think what buyers will have found, if you're trying to purchase a home, they would have found conditions quite competitive. Over the June quarter, we saw house prices increase by 5.3% in 3 months. That is a significant jump in price, well above the historical average, which is 2.8% of growth in a quarter during a period of upswing. So well above that. So that is unsustainable, that level of price growth longer term. And I think what we're likely to see is, I think the listings tide has changed, and I think we're seeing, and I have described this as in Sydney, spring has come a little bit early. And I think what we're likely to see is is going to ramp again and continue to ramp in spring. And I think that will help to dilute a little bit of competition between buyers. And what that
Mm.
will mean is we won't see as strong rates of price growth as we did kind of over those winter months and over that June quarter. I think we're likely to see prices still rise, but not as great as what we were seeing.
Isn't that such a crazy thought to think about that in the June quarter, whilst we've just hit sort of record high interest rates, I think almost 15-year high in June, and globally there's economic issues. Here we are in a quarter having record growth in the Sydney property market, right? It's kind of like thinking, what recession or what interest rate issue are you talking about? And you're probably, to your point about not seeing that same amount of growth this coming quarter, it's probably a good thing. It's not sustainable to maintain that type of growth. A bit more supply to ease those prices is probably warranted, right?
That level of above 5% growth in just 3 months is a serious amount of increase in a single quarter. But this is what I find really interesting is when you see a market bottom out, that spring back in price growth is normally quite rapid and it's sharp. And then and that's that behavioral part. People want to feel like they're buying before properties reach a new record. They want to feel like they're buying close to a price trough. And prices overall for Sydney hit a trough in December. So we've now had, about 6 months of continued persistent pricing recovery. But it's really great. I mean, really excellent observation that this does seem unreal, in terms of this growth was happening when interest rates were rising. And, economically, it's been a really challenging period of time. But what I would like to point out, my answer to that is this has happened before. So we've got a lovely graph, and perhaps we can share it with your listeners or viewers, where it shows periods of time where property prices have risen when interest rates are high or rising. And this happened back in the decade of the 2000s. Now, there were pretty much two property cycles that occurred in that decade, but we persistently saw the cash rate being moved higher and higher. But while, today and back then is very different conditions economically, because obviously it was a mining boom back then, there is one thing that unites them both, and that is record levels of overseas migration. We had a record level of overseas migration in that kind of 2008, 2009. It was just over 300,000. And we've seen last financial year was a record net overseas migration, and this financial year is also going to be close to that record. So the population aspect is certainly there in terms of driving demand for housing. And our analysis shows that there are many factors that drive demand for housing. It's not just interest rates. And that's a timely reminder, really, when you're seeing prices rise, when interest rates are rising. One of the biggest factors is population. And it's actually more of a longer term collective effect, because you might see a family, or you might move to Australia as a couple, but then it's the ongoing change in needs from housing over time, where you maybe have a child or two, or you relocate. That's the ongoing impact that population growth has on demand for housing in Australia.
Which is the fundamentals of supply and demand, right? So we're having a huge amount of demand with this migration, and supply just can't keep up, right? In Sydney in particular, supply has been easing in new dwellings the last sort of 5 or so years, just because of these local council issues and zoning issues, where developers can't get homes out of the ground. They can't build high rises, to your point, on those growth corridors and main roads and great infrastructure like they can in other states. The urban sprawl can only go so many ways. They're doing their best they can to go that southwest corridor and that northwest corridor, but supply can't meet demand. And we're about to have the biggest amount of demand in a long time.
Yeah, absolutely. And you've got to think as well, we've got population growth and coming from overseas at a time that's going headfirst into a very tight rental market. Nationally, you've got Australia's vacancy rate at 0.9%. In Sydney, it is slightly higher. It's at 1.2. But even at 1.2, that is very much a landlord's market. It's a landlord's market across Australia. And, most overseas migrants do rent upon arrival. But our rental markets were tight even before overseas migrants came back into Australia. So the issue was there already. And then you've got this flow. You can ping back demand very quickly by, upping the number of people that come from overseas. But its supply is much more that longer term, and it takes such a long time to bring supply to the market. So
Mm.
you can understand why some migrants, if you're new from overseas, most people rent. That's logical. But I do think with this tight rental conditions, what that may have done for those in the financial position to be able to do so, they may have gone straight into purchasing. Because if you can't find you need, as you said at the very beginning, is about having a roof over your head and security.
Mm. So let's talk about more, if you don't mind, data that you're then seeing on that note. So, in the rental market, I'm sure you've already touched on vacancy rates, and yeah, that's very much a landlord's market. We saw, I think, maybe 6 months ago, people queuing up at open for inspections for rental properties, and people trying to basically bid for the listing, and new laws came in, I think, late last year to prevent that for that reason, right? What are you seeing in terms of data around a shift in, you said a bit of a trend also happens as people start having kids and whatnot. We saw a big trend through COVID where people wanted more of a house than a unit. Are we seeing now units be more sought after? What data are you seeing in that aspect?
So in the rental space, the greatest rental growth in Sydney is coming from those inner city suburbs,
Mm-hmm.
and that makes sense. It's where the highest level of rental supply is. They saw the biggest dip during COVID, but what I would say is this isn't just a bounce back from the rental price that was lost during COVID. This has gone far beyond that. So I would say from a rental perspective, demand is certainly centralised in those inner areas around those university sectors. It's where we've seen the greatest rates of rental growth. And it's actually the longest period of continuous rental growth that we've ever seen across our combined capitals for houses and for units. So
what was that roughly as a percentage? Do you know?
in terms of
Rental growth.
Yeah, so in Sydney, rental growth for houses was up 13%, and for units was up almost 28% over 12 months.
Wow.
That's just 12 months. That's
Are
just
we? That was actually one of my next questions. But we're not going to continue to see that, though, right?
that level of growth is pretty significant. It's hard to imagine rental prices going backwards when you've still got a tight vacancy rate. What
Hmm.
I would say though is I think we're probably likely to see a slowdown in the rate of rental growth. I think vacancy rate still remains tight, and I think we need to do a lot to really shift those conditions. And this is not just a few hundred more rentals. This is a big uplift in rental supply that we need to get it to a balanced rental market. So a balanced rental market is where the vacancy rate sits between 2 and 3%. And remember, just to remind everyone, that vacancy rate in Sydney was 1.2%, so still really in favour of landlords. And it does differ depending upon where you are residing. And as we were talking there, I was pulling up some of the suburbs because I thought that might be interesting too. When you look at some of the suburbs, some of them have seen asking rents increase by nearly 40% in 12 months. So East Lakes in the city and East, Clovelly is up by almost 40%. North Kirkle, Haymarket, Zetland, St Leonard's, I could rattle off lots of Sydney and East suburbs where they've seen, 30% or more growth in rents in 12 months.
So the flip side to that, now we saw investors sort of subside for a period of time there through COVID. The units didn't have that same growth in prices in terms of actual purchase prices, house prices rather than rental growth, as homes did, which could also be an issue around this vacancy rate because there's not that many investors buying properties and putting this stock on the market, right? In addition to that, I know what we're seeing on the front line right now. We've got over 3,000 sort of real estate officers that we deal with across the East Coast that are saying that they've had a lot of landlords actually look at selling their properties at the moment because they've had properties that they bought, which were once positively geared, earning an income from, all of a sudden turn negatively geared and having to contribute significant amounts of sort of cash flow to, you could say, due to interest rates, whilst also potentially having to do that on their primary residence and other debt facilities, right? So it's like a catch-22. We might see landlords, less properties be rented out because landlords need to sell their properties as such, but we might see some investors come back because of higher yields. Is that what you're sort of saying there?
So I think we're starting to see investors come back into the market. Investor activity still remains lower compared to this time last year, but over the most recent months, and the most recent data from the ABS shows in New South Wales, investment activity or home loans for investors grew by just over 3%. So, investors are interesting because you've got two sides, people that are wanting that cash flow and they need a positively geared, or they're going for equity growth. And generally speaking, Sydney is a very high priced market, and to seek out that positively geared property can be challenging because it is such a high priced purchasing market. But people invest in Sydney because Sydney sees big price cycles, and so they want to see that capital growth on their home, or on their investment property, I should say, not home. I think, though, what's interesting is when you look across the different states in terms of where is investment activity growing the most, it seems to be more so in the cheaper, more affordable market. So WA, over the most recent month, investment activity grew by 7.3%. And in WA, yields are much better compared to Sydney. So let me just pull up the yields so you can kind of have that idea of comparison. So for a house, a yield is about just over 3% in Sydney, whereas in Perth, it's 5.5%. So
Wow.
much, and that's citywide, so it's a big difference. And for units, the yields in Sydney are 4.5 and in Perth 6.5. So big difference in yields. And I can understand why. I think it's an affordable market to purchase into. It's probably more accessible to people that maybe have, a lower threshold to be able to spend on an investment home. But even in Queensland, over the most recent month, investors were up by just over 5%.
So to your point, to your point, in Sydney, even if you put a significant, 20% or more deposit down, it's hard to have a positively geared investment property with those yields. But in other markets like WA, if you put a 20% deposit down, you should have a positively geared investment property, even with these current high interest rates.
Yeah, absolutely. And I think it's also logical that I do think that we are seeing a portion of investors sell off their properties. I mean, there's a lot of mum and dad investors across Australia that provide a lot of rental properties, and you can understand that the financial burden of holding them has changed so much. Then, there's two sides to this. We are seeing investors come back in, so it might mean that it just goes to another investor. But the other side to it is first home buyers. First home buyers, investors do tend to compete for similar priced properties. They tend to go for that lower end of the market. So the other side to this is what it could mean is it gives greater opportunity for first home buyers, particularly in a market like Sydney where it is hard to gain access to. And then still on that first home buyer thread, I think with high rents, record high rents, and escalating rents and tight rental markets, I think what it means for some first home buyers, they're fast tracking their decisions to purchase. And I think maybe compromising on property type or location just to get into the onto the property market and get themselves out of the rental market.
So slightly different question. I'm not sure how much data you would have on this, but I'm sure you've got some data there. But the construction sector, there's been a lot of hysteria around construction costs going through the roof, and some things like timber just literally not being even available to build homes for a period of time, and having to go on a wait list for timber. That's changed pretty quickly, I believe, overnight with these interest rates. And I did see in Sydney in particular for the last, I think, 6 months, last 2 quarters, call it, we saw across most councils new DA submissions drop around 20 to 30%. So less people putting in applications to build homes as such. What have you got any interesting data on that construction sector, and are people avoiding building homes and going for the brand new completed sort of homes and units as such because they're just scared from what they've been hearing in the news?
Yeah, so a bit of both actually. So some data but also anecdotal feedback, because obviously we're chatting to agents all the time in terms of what's happening on the ground and that kind of feedback from buyers and sellers out there. So, when you look at construction costs, costs have risen about over 30% since pre-pandemic. So costs have blown out significantly. But overall, what we're starting to see is while construction costs continue to rise, they're now starting to ease year on year. So it's still positive, still higher, but the rate in which they're growing is starting to ease. But that has flow-on effects. So what you've got at the moment is a real mismatch between what it costs to build a house and purchase new versus what it costs to buy an established home. What will eventually happen, this is more longer term thinking, is that higher cost of building will eventually feed into the established market because you have that interaction between the two. I think construction overall, there's been unprecedented headwinds, as you mentioned earlier. And I think that those headwinds are now starting to ease, but that has an impact on supply lines, in terms of the number of commencements, the number of applications, the number of building approvals. They're all shrinking. Again, it's something else that can pressurize pricing in the established market and push actually prices higher. And even in terms of that anecdotal feedback, we're finding that buyers are not wanting to commit to a home that needs substantial renovation. They want that almost turnkey, but they want an established property. They're not they don't want to commit to constructing their own home until those kind of construction headwinds really start to ease. So I think it's coming out in two ways. And I think it's going to be the longer term impacts of this are going to be evident.
Which does provide opportunity to those who are confident in the construction or renovation process and have, a friend or a trusted sort of builder in their pocket, you could say, that they know can give accurate guidance on what something would cost. The unrenovated homes are now opportunistic, right? They're probably better value.
Yeah, absolutely. And I think I always think, there's always these areas in Australia as well, like suburbs that are so tightly held and hard to get into that, if there is, either a knockdown rebuild or something that really needs substantially renovated, this is probably the period of time where that opportunity might present itself to you, because there might be less people willing to commit to a massive project like that. So I think, market dynamics are interesting. I think it does present different opportunities for different people at different times. And I was watching Today's Show again this morning, and they had someone from the construction sector being interviewed. And he was saying that construction work was starting to dry up. Like, I think what you're finding is the construction sector are working through the tail end of a big pipeline of work. It's also about timing your renovation or your construction. You need to time it when the construction sector is starting to slow down and work is drying up, because that's when you can, maybe have a bit more negotiation power, or you have a better chance in getting in with the builder or the developer in terms of which you want to give your work to.
Yeah, because when builders also have a queue of jobs lined up, sometimes they price accordingly. When they've got no jobs lined up, they price accordingly yet again. And we're hearing from some of our property partners, some architects and whatnot, that builders are actually calling them saying, after this job I'm working on, I don't have anything lined up. Have you got anything upcoming? And to that point on costs, whilst we had that crazy sort of increase in prices based off demand through COVID on building materials, now because of the opposite effect, some of these costs are easing. Some is going to be the new norm. Some costs is just here to stay, but some things like, once again, timber, I believe, is coming back down from its record high prices because they've now got a lot more of it not being needed. We've gone a little bit over time here, but this is fantastic stuff. So I only have one more question, which is the crystal ball question, right? This is the question that is the hardest to answer, but it's the question that everybody wants to know. What are we forecasting in the property market the next 6 to 12 months? You mentioned that we'll probably see rates start coming down. I think you said mid next year. What are we going to see before then? Are rates going to start coming down because we're going to need to stimulate economic activity? Crystal ball. We won't hold you to it. Just Dr. Nicola Powell's, crystal ball vision.
So we have a price forecasting model at Domain. And so we built this using classic economic time series, property market data, but we also beefed it with consumer data as well. So what people are doing online. And what it created was in areas where we have more consumer data, it actually provided a more accurate model. And that is Sydney. So and I'll focus on Sydney. I mean, generally speaking, what I'm expecting between now and the end of this financial year is that Australia-wide, we're going to be on a steady recovery. I think what we saw over the last few months was quite unusual. We saw a big jump in price. And I think what I'm expecting is much more subtle rises in price between now and the end of the financial year. What we're predicting is Sydney house prices could be at a new record high by the end of the financial year, which means they could surpass, just knock over 1.6 million. And so what we're expecting for house prices is between a 6 and 9% increase in house prices over this financial year. We're also expecting unit prices to rise, but not as strongly as house prices. And Australia-wide, what we are expecting is Adelaide, Perth and Sydney will be the only cities that will be at new record highs by the end of this financial year. But we are expecting growth across Australia. But what I would say, it's much more subtle growth. It's much more moderate. And I'll repeat, that kind of steady recovery is what we're expecting.
Which is in line with all the major bank economists, right? I think NAB and CBA have come out with similar forecasts saying that there is growth on the horizon despite, all this economic sort of headwinds, like you said. Well, that's reassuring. That's great to hear. There's some good signs there, as we said. So thank you so much for joining us in our Property and Finance podcast today. Hopefully, maybe in another 6 to 12 months, we can get you back on here and we can talk about all these topics again, and we can review what once was and now look at the more promising market in the future again. So thanks again, Nicola. I really appreciate your time.
Thanks, Theo.